Hi, this is Mohan Kumar from Brainy Bulls, and I welcome you to another episode of Nifty chart analysis using the Triple Threat Intraday Strategy. And in this video, we're going to look at the Nifty chart for April 21st, 2023, and see what kind of signals the strategy has given us. Come on, let's get into the charts. Great. So you're looking at the two chart view in trading view platform. So we have the Nifty spot on the left, Nifty futures chart on the right, and both charts set to a 3 minute time frame. So you're looking at the naked charts. I haven't brought up the indicators yet. So before I do that, let's look at the price action that we had for 21st. So the price almost like open flat, at least on the futures, but on the spot there's a slight price open slightly higher from the previous day's close, right? And then price saw a stiff resistance, and then it was a major drop from that high point, and kind of consolidated at the bottom, as you could see, right? After the steep fall, it consolidated right off the bottom, and then again it continued to fall, and then there was a major reversal during the end of the day. Okay, great. So this what happened, right? This what happened uh, during the course of the day on April 20th. So let's bring back those indicators and see, what kind of signals that the strategy has given us for this particular day. Okay, and so we would hope to take this, but this move started pretty early, right? Even well before 9:45. And let's see, where the strategy would have given us signals to take a trade in this particular fall, right? And likewise, let's see, what kind of trading signal that we got around this region and around this region. Okay, so let's now quickly turn back those indicators, locations, right? And then we'll bring up the participation indicator and then the trend meter. Okay, so now let's look at the same charts, but now with the indicators applied. And as you could see, now the price opened right above the CPR, and all the EMAs are kind of it's raising, right, right, and then the price for some reason it took a stiff resistance at the zone. It's almost like there is no indication as to why the price fell. At least no, by looking at the participation, we did not have any major participation at this. So there is definitely no trade because also the price is right above the CPR. CPR could act as a strong support, and the EMAs are all like moving higher. And until the price comes back into the EMA and the CPR, we cannot confirm on which direction the price is going to go further, right? So when the price came into the CPR and EMA band, as you could see on the futures chart, at least there was a immediate spike to the top, and then there was a big fall, right? Kind of a bearish engulfing candle. So the price is kind of very volatile at this region. It usually does this kind of action when the price is near major levels, like in this case the central pivot range and the EMAs, right? And then the price, when after this big red candle, the price started moving lower, and if at all, okay, I didn't bring the trend meter on. Okay, let's bring it on as well and look. The price has peaked, and but still we would not take a trade. It's before 9:45, and plus it's above the central pivot range, right? So we wait for further price action. So when this big red candle confirmed, which is pinning down all the EMAs and the central pivot range, right, with some participation, and if the price moves below this, now that's an indication that the price is going to go lower, and the next major stopping point is our previous day low. And this could have been a trade. Look at the indicator, it is all trending down, and we have our famous candle pattern, which is in this case evening star. Okay, we have a bullish candle and a big doji, right? Almost like a pin inverted hammer, right? And then you have a bearish candle that closes below this bullish. So this is a very nice setup, and with this red candle here with a high participation, and it's almost below the CPR, right? And then with the trend meter showing that the trend is down, so there is good scope for the price to move swiftly down to this previous day low, which is another major location, right? So this is a low probability setup given the fact that the trend meter is not at the peak; it's right in the middle. So you could have taken a small trade here, okay. Still, your risk is going to be very limited in any trade that you take. So you could have taken a trade based on this candle right here, this candle high being the stop loss, and this okay, and this candle right here, this the low being your entry point, and this candle high being your stop loss. So there's a very beautiful setup. If you're a very conservative trader, your stop loss could have been this bearish candle right here, okay, not this doji, but this bearish candle right here. So this could have been your stop loss, right? This could have been your stop loss. Let me quickly move this to the arrow, okay. And this could have been your entry point. Excuse me. All right, so and this is where you make your profits. You just follow the trend meter. The trend meter is in the red zone, and there isn't much participation here. So when the price moves swiftly down here, okay, this is where you take your profits. So it's either here, or if you wait, it's here. So Nifty options, it does not make a major difference. If you could have booked your profits here, it's well and good. Even if you book your profits here, it's going to be more or less the same. But I would say the more earlier, the much better. Because as soon as the trend meter indicates that it is in the green zone, it is time for you to book profits, okay. And this is the place where you have booked your profits, this particular pink candle, right? And you don't get into a trade yet because there is not much of participation on either of these charts yet. But when the price swiftly came down to the previous day low, okay, there is a volume candle and there is a participation, right? And the trend meter also indicated that no, it's moving higher. Correct. So this is another setup, but look at the EMAs; they're all trending down, and and the risk to reward is not much in this trade because the red candle high is here, uh, right, and the low is here, and this is what the reward is, and this is what your risk is. So it's almost close to 1:1. We usually don't take trades, if the risk to reward is lesser than 1:2, right? And usually it's 1:infinite is what we look at, but this trade is not even closer to any of the low probability setups that we have taken so far, right? In most of the charts that we have discussed so far, right? And so this is not a setup at all, correct? So let me quickly remove all these drawings. Okay, perfect. So far it's just one trade that you've taken, right? This could be this is a low probability setup again, but yes, no, this is one good trade that you could have taken. And look at the price action. The price swiftly moved into the EMA band, and it is showing a lot of participation at this point. Okay, so the price can move, but again, there is a stiff support right here. So we need to wait and see if the price is going to go further beyond the EMAs or it's going to get stiff resistance. If more participants are coming in, then the trend to the downside could be more stronger, and it can even go past beyond this previous day's low. As you could see, the EMAs are now firmly trending down, right? Now the trend meter also tried to go to the peak a couple of times, it couldn't. There's a lot of participation. The price tried to break and go past this particular high point, but then there is this candle, the red candle, with a lot of participation that came in. Now, if at all, if you want to take a trade, now this could be another low probability setup trade. You could have taken a trade right at the zone, and you could have actually trailed your stop loss to the green, and then you could have booked your profits right here, which is your previous day. So it's not big, but you have been waiting for the last 1 hour, and based on the confirmation of multiple participants entering and the trending down EMAs and the trend meter trying to move to the red zone, but it failed. But still, the trend down to the trend to the downside is firm. So you could have taken a small trade right here. Okay, so this is your next zone for you to actually look at and for taking a small trade. And now let's wait and see because the price went below the previous low point for the day. Okay, so we need to see what kind of price action comes up once the price moves back into the EMA band. Okay, once the price firmly moved back into the EMA band, You could see that the price again is seeing a stiff resistance, and as confirmed by this hammer candle, and then followed by another bearish candle with a lot of participation, right? You could see the zone, especially the zone. This confirms that the price is moving further down. So you could have taken another trade below this particular candle, and this being your stop loss, right? And you know for a fact that no, this is the place where there's going to be a lot of action, and this is where you could have taken your profits. Even though it's a low probability setup, it is worth taking a chance based on the price action, based on the trend that's being shown on the charts, and the signal that the indicators have given us. So you could have very well taken the second trade right here. Okay, so the first trade was based on this candle pattern, and it's below the CPR. It's bringing down the EMAs, and the trend meter is also midway, and you have some uh, space for you to actually ride this trend and take profits. So this was the first trade, and this was the second trade. Okay, and let's see what happens post this. If you're an aggressive trader, you could have trailed your stop loss to the EMAs, and you could have taken your profits right here. But no, I'm a conservative trader. I take multiple trades, but I do not actually give back my profits a lot, because no, your entry point was this, right? And if you had held on to this trade, you would have gone to the break even, and there is no guarantee that the price may have returned back. So I do not take my chances. As I know that this is a major location, I book my profits. Okay. If I want to take another trade, I might have taken a second trade right here, but I do not hold on to my trades until it reaches the break even point. That's not what I do. So in this case, the trend meter is almost in the green zone, right? The oversold zone. So I do not take any short positions. And that's one of the reasons why I'm not a big fan of breakouts. So in this case, as you could see, the price swiftly moved into the EMA band, and then there is a big red candle which confirms that there is going to be a breakout, right? Now this is a good indication of the breakout being obvious, and I could have gone and taken a trade here, gone short right at this point, but I do not. Like I said, look at the trend meter, it is into the green zone, right? And if at all, if I would have taken a trade, I don't have a location for me to book my profits. And beyond that, no, the trend meter also is already in the green zone, so there is no proper way to understand which way the trend is headed towards. So I did not trade. Rather, no, I would have waited on for the price to retrace back to this zone. For example, let's say if the price would have actually gone back to this place where it had a breakout, and if it had consolidated, and then if there's a lot of participation coming in, and if the price started to show some bearish candle patterns, this is the place where I would have taken a trade, and I would have booked my profits right here, the low point, right? But that did not happen, right? That did not happen, and the price actually immediately saw a reversal, right? And there is a reason for that. And the blue line which I have marked here is from the past historical price action data. Let me quickly move to the daily time frame to show how this blue line was derived. Okay, so let me go back to the daily charts. If you get to the auto mode, right, so it's going to actually bring the daily charts uh, you know you know okay, quickly. Let me remove this as well. Okay. Now all these blue lines indicates the swing highs and swing lows at various points in the past, and you can also see that now I've termed as gap open high, gap open low. It's because post a gap open, right? For example, now this gap open is marked for 313. So this is the 9th March candle, and the next day on 10th March, right? There was a gap open, and the next day the price swiftly moved way past this high of the gap open candle, and then it fell so strong that it went past below all the previous low points. Now this is a major blow, I would say, and this high is very significant. So we mark this high and we term this as gap open high. Okay, because post the gap down open, this is the highest point before the price actually made a swing low. So this is very significant because the price actually moved past this zone, right? On 5th of April, the price moved past this zone, which could have acted as a strong resistance, but it moved past the zone, and it went further, higher. And now when the price is going to come back to the same level, right, this level, this could act as a strong support, and hence this level was marked as one of the key levels. And on the intraday basis, when the price comes back to this level, there could be some reaction, and that exactly what happened on this particular day, right? When the price came down to this level, the price saw a lot of participation, right? As you could see, there's a lot of participation. Let me actually bring back those charts for a better view. Okay, and you see a lot of participation right at this point, and the trend meter is almost in the green zone. And there is another important fact. Now look at this low point and look at this low point, right? It's a deep fall from here, but look at the trend meter, right? It barely moved from this low point to here, right? In fact, this made a higher low. So this is a price trend conflict, which indicates that the trend to the downside has weakened, right? And you could expect a reversal. So based on the indications, right? So based on this, stiff support from the past historical price action, and based on the trend meter, price trend conflict, based on the participation, you could take a trade once you see some confirmation based on the candlestick patterns. So candlestick, you could see a nice hammer candle with a lot of participants confirming that the price is going to reverse, and then you wait for a couple of more candles to see how the price behaves, because this could be a fake reversal. But so you need to wait for some confirmation. So you see a red candle which is kind of an inverted hammer, and you see a inverted hammer here, and this red candle, a voluminous candle with a lot of participation. Now this is the high that you want to see if the price is going to go past this. So the moment the candle closes above this, now this is the candle that you enter, and this is going to be a stop loss, right? And you stay in the trade as long as the trend meter gets into the red zone. And as you can see, the price firmly moved. You're trailing the stop loss to the green moving average, and the moment the trend meter is at its peak, right, and also the price is at a level where it took a strong resistance, right, and this is the place where you could have booked your profits. So this is your third trade. This could have been a nicer one compared to the past two trades. So this is a very good trade. And the fourth one could have been like when the price sees a stiff move from the bottom. In this case, the price swiftly moved through the previous day's low post, a breakout, right, and then steered past through all the EMAs. It indicates that the momentum to the upside is very strong, right? And if the price has a retracement or a pullback into the EMAs, now this is where you look for some pullback trades as a trend continuation pattern, right? So that's one of the patterns we discussed. So this is a nice example for that. So when the price swiftly moves past the EMAs and retraces back to the EMA zone, and look for the price action, see there are five candles right here, which is getting a strong support. So you could actually, mark the high of the support right here, right? And if the price goes past this, you could take a trade. It's not a high probability setup. The trend meter, though, no, it has slightly dipped, right? And you could take a trade, when the trend meter gets back into the red zone, right? In this case, you could have taken a trade. CPR is a strong zone of resistance, so you could have actually held on to your trade as long as the trend meter gets back into the red zone, and you see some kind of candles with major participation. So this is another small trade that you could have taken, right? So as you could see from the charts, all these moves, as made by the price action, right, in conjunction to the signals that the indicators have given us, we have taken trades, at areas where the price may move lower, and from areas where the price may move higher. No, this is why a powerful strategy is very important. Intraday trading is not as easy as it seems to be, right? Unless you have a powerful strategy, you will not be able to see the kind of price action, and act upon it. If you like what you're seeing, right, and if you want to completely take up a course, an end-to-end course on intraday trading, on to trade in Nifty options based on this triple threat intraday strategy, I've formulated a course, right, in a very structured and organized way. See, we are looking at these chart analysis on a daily basis. Not all patterns come up on the chart, on a particular day, right? And so we're looking at information in bits and pieces. So you will be finding it difficult to connect the dots and understand what to look for, and which is the right pattern and which is not. Even though on this particular chart, the points that are being discussed may sound, right, and may sound simple, but you will miss the main picture. So you will have to sit through a course which is completely organized, which actually gives you facts from one, topic wise. So when we talk about the patterns, price action patterns, we look at all the price action patterns at once. Then we look at all the candle patterns at once. Then we look at each indicator as to what they are, right? How significant they are, and then we understand, in overall, when we get the main picture, right, when these indicators in conjunction to the price action pattern and in the candlestick patterns, right, they form the whole picture. And based on all of these, we then actually see a particular trade, right, uh, uh, and then we actually execute the trades, the right entry points and the right exit points, because you will have to sit through this day. You will not trade for the first 30 to 45 minutes and the last 30 to 45 minutes. So you have 5 hours of trading time every single day. So if you want to sit through the day, you should be focused, you should be disciplined, and you need to know what exactly you have to see. So you have to train your brain to see the patterns that the chart brings up. And for that, you need to have a clear understanding about what those patterns are in the first place, right? How you will have to read those patterns, and along with the indicators, how do you assess whether the price is going to go lower or higher, and based on which you take long or short positions. So if you're really interested, please do contact me at my WhatsApp, or drop me a message, to my email ID. You could get further details about this course, what you get along with this course. Like, all these indicators are going to be given to you free, for lifetime. You will get 90 days worth of charts and video recordings, and you get 30 days of support to clarify doubts and get answers to any of your questions you have. All this, as part of the course, you're getting. It's for one simple reason, that you have to gain confidence and you have to become independent as soon as you can and start trading with real money. So post the course, you do 30 days of, like, paper trading, right, based on all the knowledge that you have gathered through the webinar and all the support that you're going to get for the next 30 days, right? So you're going to do paper trading. And then once you gain confidence, once you're able to see the patterns, once you have trained your brain to look at the right patterns, right, you are not going to use your real money to trade. And post 1 month of, your trial in the markets with, doing paper trading, that is when you put in your real money and take trades. So it's a wonderful course, it's a wonderful investment. Okay, trading is a great business, provided you know what to do and how to do it. Okay, so until I see you in another episode of Nifty chart analysis, it's bye from me, and take care of you and your loved ones.